Welcome back, YouTube. My name is Nasco from The Great Reset, and today me and my friend Steve the CPA are gonna connect the dots for you, explaining to you what all the new changes in the tax code from the Biden administration mean for you. Whether you're gonna be classified as rich, whether you're gonna have to pay taxes on unrealized gains on your stock trades, or anything else. Stick around, it's a little bit of a longer video, but it's worth it and it's really good. Let's go. All of this was prompted due to this article from CNBC explaining the new taxes that Joe Biden is proposing, but I'm not an expert on it, so let me get you over to the expert. Steve, how you doing, my man?
Pretty good. Thanks, Nasco. Thanks for having me on.
So tell me, what do you have for us when it comes to Joe Biden's taxes?
Okay, so today we're going to discuss Joe Biden's proposal on the new taxes and changes to the tax law and the tax code. Of course, it hasn't happened yet, but like you mentioned, CNBC just came out with an article outlining what potentially may be changed. But before I go into this particular topic, I would like to give you a slight history of how the income tax came about. Yeah, to understand the today's tax climate, we should understand the history of taxation and what happened prior to 1913. So prior to 1913, the federal government was much smaller than it is today. It didn't have nearly as much power. And any taxes that were levied, whether they be direct or indirect taxes, had to have a specific purpose, and more in particular, they had to be apportioned. So what apportion meant at the time, at least, was whatever taxes the federal government collected had to be distributed to the different states based on either head count or something else. So in reality, what that meant was each tax had to have a specific purpose, had to go for a specific purpose. Once the job was done, they basically repealed the tax. So again, the government was pretty small. So for example, the Revenue Act of 1861 was passed in order to help the Civil War, and eventually it was repealed in 1872. So once it did the job, they got rid of the tax. Throughout the 1800s, the federal government tried different ways of passing various taxes, but they were often struck down as basically unconstitutional once they took care of whatever they were supposed to take care of. And there's a famous court case that made it to the Supreme Court called Pollock versus Farmers Loan and Trust Company. This was a 1892 case. And in this case, the Supreme Court of the United States ruled that any income from personal property and other related income were direct taxes on property and therefore had to be apportioned. So in other words, what that did was the court told the federal government that they cannot levy a tax for basically any reason. So let's fast forward to 1913. Okay, so what happened in 1913, the federal government or the Congress ratified the 16th Amendment. So what the 16th Amendment stated was the Congress shall have the power to lay and collect taxes on income from whatever source derived without apportionment among the several states and without regard to any census or enumeration. So what does that mean? So what ended up happening was the Congress gave the power to the federal government to levy any direct tax. In other words, they could tax people based on any income. As you can see, it says from whatever source derived. So it's a pretty broad statement there. And they didn't have to apportion. They didn't have to have a specific purpose. They could just go ahead and levy the tax, and that was it. So right away came the Revenue Act of 1913, and the Revenue Act of 1913 set forth pretty much the beginning of the personal income tax. But this was a very hard sell to the populace because obviously nobody liked that tax. Nobody wanted to get taxed. Everybody wanted to keep as much of their income as possible. The way they sold this to the populace, they said, well, we're just going to tax the rich. This is a tax on the rich. It's not going to affect most of you. You know, at the time you had all these barons, making a lot of money in the oil industry, and the early 1900s, there were a lot of people getting rich. So the way this tax was sold to the populace was, don't worry about it. That's something that's only going to affect the rich. It's not going to affect you.
It was also a time with a whole bunch of monopolies, right? Basically, every sector of the economy was monopolized by one organization or another, right?
That's exactly correct. So again, what ended up happening was they said it's only going to be a tax on the rich. Don't worry about it. So the Revenue Act of 1913 called for a income tax on individual income of 3,000 for individuals and 4,000 for joint filers for married couples. So again, up to this amount, up to 3,000, there was no tax. The tax was levied on any amounts earned over 3,000 or 4,000. And the tax was only 1% up to $50,000. And keep in mind, this is not adjusted for inflation. So, but there's one thing that's pretty interesting. Keep in mind that this is in 1913, and these numbers are not adjusted for inflation. So 3,000 at the time was the equivalent of about 60,000 in today's money. 4,000 is probably about 75,000 or so in today's money. So again, what Congress said, and they were right at the time, that yes, this is not going to affect most people, because keep in mind that in today's world, the average household income in America is about, I want to say, 56,000 or so. So in other words, the average Joe wasn't affected by this tax at all. And even if they were affected, it was only 1% on income above 4,000 or 3,000, all the way up to 50,000, which was probably the equivalent of a few million today. So in other words, when the tax was passed, it didn't really affect anybody other than the rich, right? Once the tax was passed, and it passed all legal challenges and it became constitutional, at least per the courts, then they started lowering the limit. For tax year 1918, the tax rate on income of up to 50,000 had gone up from that 1% all the way to 20%. Okay, and somebody say making 10,000 when it was now in the 3% tax bracket, as opposed to 1% when the tax was introduced.
That kind of makes sense during wartime, but let's
Right.
say, did it drop back down after the war was over?
Yeah, that's an excellent question, and this is exactly where we're going. So another thing that happened was inflation started lifting everybody. I don't want to say out of poverty, but people started making more money, not necessarily becoming more richer, but they started making more money. So the tax rate slightly dropped, but then came World War II, and right after World War II, the top tax rate stayed pretty high all the way up until the 1970s. So I'm sure you've heard Congress people like Bernie Sanders and AOC saying that, well, back in the 50s and 60s, the highest tax rate was 60%, 70%, and they're technically true. That's technically true, but keep in mind that nobody really paid these high rates. There were a lot of loopholes. Meanwhile, the top echelon of income earners had already become subject to the personal income tax. So in other words, what ended up happening, the tax was introduced that as something that would only affect the rich, but eventually it affected pretty much everybody. It affected your average Joe. So in the CNBC article, there are a few tax proposals that are outlined. First one being tax capital gains as ordinary income for income over $1 million. So I'll explain what that means. The other one is change the structure of the estate transfer tax, a wealth tax on high net worth individuals, elimination of the step up in basis, and increase in tax rates. The most interesting one and the most dangerous one, I would say, is the wealth tax. Okay, and the reason for that is, it's first of all, it's something new. We're still not very clear as to exactly what the tax is going to cover. I mean, is it going to be a tax on total net assets, or is it going to be a tax on certain appreciated assets? Is it just going to be a tax on unrealized gains?
To me, it sounds like if you're a billionaire, right? Let's say you have $1 billion.
Mm-hmm.
We're going to tax you 1% a year. Let's say,
Right.
what is it, like 10 million a year?
Yeah, that's what it sounds. And if you read the CNBC article, it says that it's going to be a tax on individuals with a net worth of 50 million or more. So in other words, there's going to be one tax rate from 50 million to $1 billion, and then from $1 billion and up, it's something different. So the way this, tax is being pitched to the American people is, hey, don't worry about it. This is just something that's only going to affect the rich. You're not rich. You're not. I mean, most of us are not nearly as rich as having net assets worth $50 million. So that's not going to affect you. And you can already see where, we've probably
Okay.
heard this one before, right? It's only
Yeah.
going to affect you. Don't worry about it. It's only going to affect the rich. It's not going to affect you. Nothing to worry about. And most people are, they're pretty accepting of that. They're saying, well, the rich are pretty wealthy. Why not tax them? Why not redistribute some of that wealth? I mean, it's not going to affect me, so why should I care about it, right? And again, keep in mind, this is exactly how the income tax was introduced. Another issue, if a tax like this is passed, is how are you going to deal with the fluctuation in asset value? So now, if we're talking about stocks, that's pretty easy. But if we're talking about other things that are some kind of a personal business or something of that nature, I mean, how do you value it every year, and how do you account for the difference in value? So that's going to be a nightmare. But again, the income tax was introduced as something that's only going to affect the rich. It trickled down to the ordinary people, and the rich found out ways to get out of it. I feel that this is where we're going with the wealth tax as well. Again, it's introduced as something that's only going to affect rich people. We're going after the rich. Don't worry about it. And eventually they're going to, like I said, they'll keep redefining who's rich and what wealth is. And it's coming down to affect pretty much ordinary people, or whatever is left from the middle class. This brings me to his next proposal, and this is the estate transfer tax. So the current law is, and this was changed under Trump in 2017. Under current law, any current estates over 11.7 million are subject to the transfer tax of 40%. Anything below that amount goes to the heirs, and I'll explain what that means. So the 11.7 million is about to be reduced back to the 5.5 million, which that's what it was prior to 2017, and this is happening by the year 2026. And the Biden administration wants to reduce that 11.7 million down to potentially 1 million. So let me explain in practical terms what that means. So let's say that if the current exemption is 5 million, which again, I think that's what it was prior to 2017. Let's say that a person dies with the following net assets: a house in California with fair market value of the date of death of $1.5 million. So when the person dies, that's what the house is worth. That's not what he paid for it, but that's what it's worth when he dies. He also has a bank account of $500,000, and he also has stocks that he purchased before, but they are worth $500,000 when he dies. So his entire estate, the entire estate of the deceased, is worth $2.5 million. So because there's a 5 million exemption, that 2.5 million, the total, the house, the bank account, and the stock will transfer to the heirs completely tax-free. So now this is under the current law. Now let's take a look at what's going to happen if Biden decreases that amount to 1 million. So again, the total estate is 2.5 million, but now the exemption is only 1 million. So that the first 1 million is not going to be subject to the estate transfer tax, but the next 1.5 million are going to be subject to the estate transfer tax, which is pretty high. It's at 40%. So in other words, the estate, before it's transferred to all the heirs, is going to have to pay the transfer tax of $600,000.
My understanding is that this is basically if you die without having prepared a trust or a whole bunch of other vehicles that, let's say, you're over the 11 million, whatever, 11.7 million. Let's say you have 100 million. There's a whole bunch of legal loopholes, whether you have 100 million, a billion, where you create trusts and a whole bunch of other vehicles that allow you to basically funnel that to your heirs tax-free, regardless of how wealthy you are.
Yes, what you just said is partially true. There's a lot of planning that goes into it, but yes, part of it, I mean, you'll still at 100 million, you'll still be hit with some tax, but I'm sure you can get out of a lot of the taxes, and that's where estate planning comes. But keep in mind that if we're talking about estates of a few million, these are not huge estates, and to have a few million, especially in states like California or New York, it's not that impossible. I mean, if you have a house that's worth $1 million, you're not rich by any stretch of the imagination.
No.
You're just average. So, but yes, you're correct. There's certain estate planning techniques that can help you mitigate some of the tax. But this is generally how the law would work. If threshold drops to $1 million, a lot of people will be hurt by this. So again, you can see how this presents potential problems. So now let's look at somebody who inherits a house. Your father purchased a house in California in 1960 for $100,000, right? He dies in 2021. Okay, when he dies, the house is worth now 1.1 million. So you received the house, you as the son, you received the house at 1.1 million. So under the current law, there's something called step up in basis. So your tax basis would be the fair market value at the date of death. When you receive the house, your tax basis being 1.1 million, you turn around and you sell it right away for 1.1 million. You have no gain whatsoever. What Biden's been saying is that he would like to get rid of the step up in basis and revert to what's called refer to what's called as a carryover basis. Now let's take the same example again. Your father purchased a house in 1960 for $100,000 in California. He dies today, and you inherit the house, which is now worth 1.1 million. Let's say you want to sell the house, get the money. So you sell the house right away for 1.1 million, but now you get the carryover basis as opposed to the step up in basis. So now you have a tax basis of 100,000 and you sell the asset, which is the house, for 1.1 million. Now in this case, you have a short-term capital gain of 1 million, which would be taxed at the ordinary tax rates. So again, you're inheriting the house, and under the new law, all of a sudden you'll probably end up paying, $300,000 or $400,000 in income tax on that. So, and again, all this ties to what Klaus Schwab said about, not in the future you're not going to own anything, you'll be happy about it. I feel that all these proposed tax laws are basically going into that direction of wealth redistribution and people having less and less. And I don't see this as a good thing, but again, we'll see how it's going to play out. In addition to that, part of the proposal is he would like to raise the actual tax rates. He would like to raise the long-term capital gains on individuals making over $1 million. Now, for anybody that's making over $1 million and has long-term capital gains, as opposed to the long-term capital gains being taxed at the reduced tax rates, they'd be taxed at your ordinary income, whatever tax bracket you're in. And if you're making that much money, it's probably you're going to be in the 39% tax bracket. The way they're selling this particular aspect of change to the tax code is they're saying, well, somebody who works on Wall Street and consistently makes over $1 million, it's only fair that they get taxed higher, right? But what about somebody that's has a normal business and he decides to sell the business, and again, just 1 year he has pretty substantial income. His long-term capital gain, he's going to be forced to pay the higher tax on the long-term capital gain. I personally don't feel that long-term capital, or at least certain long-term capital gains, should be taxed at all, because a lot of the long-term capital gains are a result of inflation. If you purchase gold back in 1950s for whatever the price was, and you sell it today at for $1,600, do you really have a gain? Well, I mean, I think that 1 ounce of gold that you purchased back in 1950 bought the same amount of goods as it does today. So we just have inflation, but that's a different story.
See, that's the biggest problem I have with this. And I'll tell you where my biggest conflict is. I go look at all this long-term, short-term capital gains from the point of view of money doesn't smell. So in my eyes, you can have different thresholds for income, that's fine. But differentiating income between whether you made it on the stock market, whether you sold the business, or whether you got a higher salary shouldn't matter. So one case, a business owner sells his business, he pays more tax. In another case, a guy who makes 100,000 a year gets a promotion and makes 200,000 a year, they pay the same proportion tax. That's where I have a problem with the differentiated capital gains versus regular income. Income is income. Money doesn't smell. So you can have different step-ups, whether it's over $1 million, under $1 million, different percentages of what you tax people for. But if they're going to equalize just income, I'm all for that. I don't have a problem with that one way or another.
Yeah, I see your point, and a lot of people, feel the same way. But keep in mind that that's why we have differences between the tax rates for short-term capital gain and long-term. So Let's say you're day trading, any type of day trade where you buy and sell stock the same day, or maybe sometimes in a matter of a few minutes. These are all short-term capital gains, and they are taxed just like your ordinary income. But the reason why they have different rates for long-term capital gains is because they would like to encourage people to invest and keep their money in certain investment, and your investment is at risk. Again, keep in mind when you're investing a large portion of your money in some company, hoping that the company does better and progresses and so forth, you're risking your money. So they would like to, again, my guess is that this is why that's why they have reduced rates on long-term capital gains, is they would like to
Wasn't that a
encourage people to.
Bush law that passed the reduced
No,
long?
well, no. This has been the case for many years, for I believe over 30 or 40 years.
Well, in the last 30 or 40 years, inequality has grown a lot. In my opinion, money doesn't smell. I don't mind lowering all the taxes to, let's say, average. Let's say, what's the regular income for somebody making 100,000?
Somebody having taxable income of 100,000, maybe the federal income tax rate would be 16-17%. I'm not sure.
Okay, then to me, this is not an issue. To me, this is a good thing. If they make that not at 1 million, but at $0, everybody's income is treated the same way. That's a good thing. Money doesn't smell. Let's say this doesn't apply to retirement accounts, right? This is just for people investing in the stock market. So you took a risk and you won. Congratulations. Now pay me the tax. I don't see it as a negative thing. The tax rate itself can be adjusted. That's a whole different story. But the actual treating of money differently shouldn't be treated differently.
I sort of agree with you. That's why I didn't really focus on the capital gains change. That's why I focused on the wealth tax and as well as the step up in basis, because I think this is pretty underhanded, at least in my opinion.
The wealth tax, where they drop it down to $1 million, they're basically saying anybody living on the coast, you're rich.
Exactly. What's going to end up happening is they'll keep redefining who rich is and what wealth is. So they'll start with somewhere very high where most people don't care about it. Then they're going to keep lowering the bar, and the rich people will find ways to get to not pay it, or at least to reduce it. But when it comes down to regular people, it's going to be harder for them to get out of it. This is exactly how the income tax came about and how it developed. So I see a correlation of between the two.
Yeah, government's always done it. Is there anything there for unrealized capital gains? Because that's the craziest part.
Well, and that's the wealth tax. I mean, we're going back to the wealth tax. And unrealized capital gain is you purchase. Let's just go back to that example. You purchase a stock January 1st of 2020 for $100. And on December 31st of 2020, this stock has appreciated to 150. But you haven't sold it yet. So you have an unrealized gain of $50. Now, is it fair to tax you just because you have?
This is actually in the proposal to be taxed? This is
this is my understanding of what the wealth tax is going to be. Yes, and again, keep in mind it's not going to affect you first, but eventually.
Well, that doesn't see again. That doesn't matter because I look at money as money. To me, it doesn't matter whether it's going to affect me or it's going to affect a billionaire. It should be treated the same way. This is going to force such volatility in any asset class, stock markets, houses, anything of value. Basically, you have to account for paying a VIC like you pay to the mafia on a monthly basis or yearly basis just to keep existing. It's not much different.
Exactly, and let's look at the problem. Let's just look at a potential filing of that tax. So let's assume that the wealth tax is passed on net assets, on all of your net, not just investments, right? So your house, your business, maybe you have some investment in art. You have some stock, you have cash, whatnot. So let's say that all of your net assets are $100 million, right? On December 31st of a particular year. And let's say the next year, stock market drops, and now your stock used to be 50 million, now it's 10 million or 20 million.
Let me give you a more relevant example. That's with me. So, I had a restaurant, right? 2 years after I bought the restaurant, I doubled its sales. So if I went to sell it 2 years after I bought it, I would probably get between 150 and 200% for it from compared to what I paid for it. Now, in those 2 years, I didn't make 150% more. I just doubled the sales, but it would be valued much more as a business compared to a business that I bought. So I would be, if that value was translated to my taxes, I would be broke a year after I got it. So
Exactly.
essentially it doesn't force you to grow anything. It just forces you to stay on the same level,
You're
which comes
absolutely
to
right.
it comes to the point you own nothing and you like it. Because if you own something, you're gonna be paying for it and you're not gonna like it. Kind of makes sense. Uh,
Exactly. Yeah, that's a really good point. So again, going back to my example with the stock, is it fair for you to pay a capital gain income tax on a stock that you haven't sold? I mean, you don't even
no.
have the cash. How are you going to pay for it? At least wait to sell it, figure out what the capital gain is, and that's when you pay the tax. That's how the current law works. So asking people to market all their securities and pay tax on them is it's going to be a nightmare. I don't know how it's going to work. Are you going to be taking credit next year if the stock value drops? And who knows? But again, this is where they're going, and
Well, I think
we'll
that
see where.
I think what they're doing is, my honest opinion is, they're not going for it. What they usually do, like, and when I say they, I mean government in general, but just not just government, but in general, they will threaten you with something really bad, like unrealized capital gains. They'll say we're gonna pass that. Then there's gonna be an outcry, like me and you talking right now, and a whole bunch of other people. And then they say, okay, okay, we're not going to do that. We're just going to do the transaction tax that Bernie Sanders proposed, which applies only to high frequency traders. And then we say, fine, okay, just do that. Don't mess with me. Done deal. I think that's the play. It's not actually, they don't expect to pass that. They don't know how to collect that tax. They don't know. It's going to create so much fraud. It's going to create basically a gray or black economy. People not reporting incomes, taxes, sales, trading in other currencies. Cryptocurrency is going to explode just because people are going to want to get out of the dollar system where the government can track them. But if you say, okay, we're not going to do that, we're just going to do the transaction tax, let's say a penny per transaction or per 100 shares sold and bought, which is what the high frequency traders do, then everybody's going to be chill out. Everybody's going to chill out and it's going to
Yeah,
pass.
you're absolutely right. I mean, they may be using this as a negotiation tool to get something else. That's quite possible. But again, my concern is that first of all, they pass it on such a high level that most people are not worried about it. It it's going to be easier for any constitutional challenges to be struck down. And once this happens, one, it's deemed constitutional for them to tax unrealized gains and tax wealth. In other words, just tax your net assets even if you don't have any income. Then they start redefining the different tax brackets, and eventually it comes down to, again, that's what happened with the income tax, and this is potentially what can happen with the wealth tax. So we got to be careful here. Just because it passes on some really minuscule level that doesn't affect most people doesn't mean that eventually it's not going to come down and bite you in the rear.
We have a big deficit. Is that why we need more taxes, or do you think it's something different?
I'm not saying taxes are not needed. Obviously, they're needed, but there's quite a bit of taxes that we pay. And it's not just the federal personal income tax. I mean, there are other taxes. So there's federal income tax, the personal income tax. There are state taxes, the state income taxes that we pay to a lot of states. There are various local taxes. There's sales tax, and the sales tax is split into part of it goes to the state, another part goes to the local municipalities. When you drive your car, you purchase gasoline. There's gasoline tax. There's federal gasoline tax. There's also state gasoline tax that's included in there. Some states, such as California, impose sales tax, reduced sales tax on the gasoline as well. Car registration fees that you pay that supposedly pay for the infrastructure. There are all
Property
kinds of
taxes.
yeah. There's property taxes on your property, exactly.
Yeah.
and that's pretty big. I mean, counties collect property taxes to pay for schools and other local infrastructure. There are utility taxes that you pay. There are communication users taxes that you pay on your cell phone. There are hotel taxes when you check into a hotel. There are parking taxes. There's all kinds of taxes. I mean, I don't think I covered all of them. So
No.
we already paying a lot of taxes. So a lot of taxes, and all these, most of the taxes that I mentioned are indirect tax, such as the various local taxes like sales tax and other business taxes, utility taxes. So we're already being taxed for the various infrastructure projects. That's something that didn't happen 100 years ago.
Well, there you have it. Now you know why Joe Biden wants to raise your taxes and how anybody would be classified as a rich person, regardless if they're just rich on paper or they live on the coast. If you have any questions, please leave your questions down below in the comments. Hit the like button, subscribe, and if you get a lot of questions about taxes, me and Steve are going to do a follow-up video answering all of your tax-related questions. Thank you very much for your time. Have a great day.